Have you ever felt that traveling by train would have been faster than taking the flight? I'm sure this recent Indigo fiasco would have made you feel. Whether you were there at the airport or not, it would have been better for you to travel by train than by a flight. But what if, on a regular basis, any part of the year, whether it is festivals, no festivals, or any time of the year, the probability of a train reaching faster than a flight is high. That means most of the time you always reach fast. How it would make you feel? Yes, it seems impossible, right? But in the investing world, in the mutual fund world, I am going to share with you something like this. A fund category where you pay less, but the probability of you getting better returns is high. In fact, as close to 100. And that is what I'm going to share with you. This amazing category called LNMC 250. Yes, it's an index fund, but it's an amazing category. It can beat not just Nifty 50, but also most of the top large cap funds. And that is exactly what I'm going to talk to you today. Hello, I am Franky Fernandes. I'm the founder of Harmony and Money. It's a community for young families to build their wealth, to cultivate good habits, saving habits, know how to invest, where to invest through education, and also build a strong relationship with your spouse. I'm a certified financial planner, and I'm also a certified marriage coach and a certified executive coach helping professionals in their career. You'll find all the links in the comments in the description box. I conduct webinars most of the weekends where I talk about these three secrets to grow your wealth and your marriage. And I also introduce my community. So you're welcome. Click the link and register and join the webinar. So let's get into today's video without any further ado. So even before I talk about this new index fund and this killer category, this amazing category, I want to start with the importance of large cap in your portfolio. A large cap fund or large cap companies are essential for any portfolio. They are a part of your core portfolio, a foundation portfolio. Whether you are a conservative, aggressive, or a moderate risk profile investor, it's essential that you have large caps. Large cap companies are stable companies. They give dividend. They will continue to be in business. They have strong competition because they are large companies. When the market crashes, they don't crash so much. They recover faster, and they continue to give good returns. So it's a very important part of your portfolio. So you must have large cap funds, flexi cap, right? These funds are very important for your portfolio. You can't just have mid caps and small caps. Mid caps and small caps crash much more, and they take time to recover. For 10, 15, 20 years or much more, they are the best. But for 5 to 10 years, having large caps is very important. Now, what is the challenge of having large caps? Most large cap active funds do not beat the benchmark. So here's a news item from valueresearchonline.com, which does research in stocks and mutual funds. It says only 9 out of 26 large cap funds beat their benchmark. 9 out of 26. And they have done an analysis here. So based on the BSE 100 TRI's performance, we had the following observation. 9 out of 26 large cap companies outperformed the benchmark. Canara Robeco, Nippon, and ICICI Prudential. The other large cap funds that beat the benchmark are so and so funds. And another news item, it says 15 large cap funds failed to beat benchmarks over 5 years. Right. So if you see here, large cap underperformers in 5 years, you've got Axis, Bandhan, DSP, and several others where the scheme's return has not been able to beat the benchmark. So there are a lot of the active funds, active large cap, do not beat the benchmark, which means you have to be very careful when you purchase a large cap fund, because you don't know. There's a high probability that Nifty 50 will beat that benchmark over 5, 10, 15 year period. And even if you pick the best fund, There is no guarantee that it will remain best 5, 10, 15, 20 years. Let me share with you a quick data. So here is this data of the large caps, top large caps. Okay. So here, if you see Nippon India large cap, if you see here, it is in the top 4 years. Now it is upper mid. That means the second. This is the top tier, the top percentile. Here it is in the second top percentile. Here it was at the bottom. Now, if you see here, Axis, for example, here for 4 years it was in the top. Then it became bottom, bottom, bottom. It is still in the bottom. So, which means you have to constantly monitor large cap funds, because the moment it goes to the bottom, right, you will have to sell it and go again, find another top fund. Now, if you find another top fund here, for example, Canara Robeco, 3 years, then again it is gone to the bottom. So it keeps going up, down, and you can't keep monitoring and can't keep selling every time it reaches the bottom, because the bottom it again goes to the top. If you keep doing that, you are churning and you are paying capital gains tax, and you are constantly monitoring. So we see that most don't beat benchmark. Those which beat the benchmark don't beat benchmark all the years. They also fall from the top to bottom. So the only way is to have a Nifty 50 benchmark. That means Nifty 50 index fund. Because most of the times you will be getting good returns and you don't have to monitor. But there is one problem. You don't get returns as much as the top large cap funds. So the top large cap funds, if they're giving 15, 17%, Nifty would give 12, 13%. So there is a gap in terms of returns. You want good returns because large caps categories, large, mid, small, flexi caps and all, large caps gives the least returns. And even in that, you go for a Nifty, you lose out. But what if I tell you today that you can actually buy a pseudo large cap, like everything about large cap, huge exposure to large cap, but gives you superior returns most of the times compared to Nifty 50, and also gives you better returns most of the times compared to large cap. That means you don't have to monitor. You'll always get better returns than Nifty 50, which actually beats most of the large cap funds. You also get better returns than the large cap funds. And I'm going to share with you some mind-blowing data. And then you will know why I am betting on large, that is LNMC 250, that is large and mid cap 250 index. There is a lot of data, I have pulled this data from the official websites, and I have taken the returns, the performance data of large cap funds from NJ, which is actually pulled from fund fact sheets. So the data is authentic, and based on that, I've done this analysis. A great category where you have to just fill it, shut it, and forget it for 5, 10, 15, 20 years also. It's an amazing product. Let me quickly share with you the details. Now, large and mid cap 250, that is LNMC 250, is a very different product compared to large and mid cap funds, right? There's a small distinction which I'm going to share with you. Look at the screen. So here's a quick comparison. So if you see here, it's a passive, management style is passive. Here it is active, large and mid cap active fund. Here it is LNMC 250 index fund. This is important. It uses the top large cap plus next 50 mid cap, that is 250 stocks. Same here also, but this is the big difference. This is the differentiator. It's 50% large cap and 50% mid cap. That means if you invest a lakh, 50,000 will go into the large cap and 50,000 will go into mid cap funds in that 250 universe, and this is 100 universe. Sorry, the 150 universe, and this is 100 universe. Whereas in a large and mid cap active fund, it is different. So we are not comparing this. This is not today's video. This is different. So here it is minimum 35% large cap, minimum 35% mid cap. The balance could be large, mid, small, anything. So we are not comparing this. We are only seeing this. So we will quickly now, these are a few things we'll do. I'll compare large and mid cap 250, that is LNMC 250 with Nifty 50. We'll compare the 5-year CAGR, the 10-year CAGR, the 15 and 20-year CAGR, okay, in this section. And you'll be surprised to see the difference. So here is a comparison of Nifty versus large mid cap 250. So here's a comparison of Nifty 50 versus Nifty large mid cap 250. That is Nifty LNMC 250. Now, if you see here, the 5-year CAGR, in the last 5 years, Nifty 50 has given 14.02, whereas LNMC 250 has given 18.93, almost 5% extra returns. And in 10 years, it is 15, that it is given 2.5% extra, 15 years, 2.6, and 20 years, it is given 1.57% extra. And what does that translate into in terms of rupees? Or if you had invested, for example, if you had invested 10 lakh rupees, what would have happened in the last 5, 10, 15, 20 years? So in 5 years, Nifty 50 would have made 19.2 lakhs, whereas LNMC 23.7 lakhs. So in all these 5, 10, 15, 20 years, see the difference. You would have made 4.5 lakh extra, 8.3 lakh extra, 18.8 lakh extra, and 30.5 lakh extra. So investing in LNMC 250 would have given you extra. But now the question is that, what about the risk taken? What about the volatility? And I think that is very important, because if LNMC very risky and the Sharpe ratio is low and high volatility, then it doesn't make sense. You are better off with Nifty 50. But let's take a look. If you take a look at the volatility, 5-year, it's almost the same. 10-year, almost 16.21, 16.28. In fact, 15-year, the volatility is less. And by the 20 years, the volatility is less, which means it is not so volatile. And now another parameter is the Sharpe ratio. That means excess return per unit of risk. For 5 years, the Sharpe ratio is much better. 10 years, it is better. 15 years is much better. See, even in the Sharpe ratio, that means the risk it takes, it delivers much higher returns. This is the true indicator of a category, which means it is giving you in volatility, in returns, it is much better. Volatility, it is almost the same. And Sharpe ratio, it is much better. The only thing is the drawdown. That means in 5 years, in between 5 years, when the market falls, the drawdown is higher. That means it falls more. That means in crashes, LNMC can fall more. But despite those deeper drawdowns, long-term CAGR and Sharpe are still better, rewarding investors who stay invested. And 5 years, within 5 years, there could be a drawdown. It may fall down, crash. But within the 5-year period, it straightens up and you get good returns, which means it is superior. That means you need not monitor your fund if you invest here. Don't monitor, just like Nifty, but you get much better returns within 5 years, 10 years, 15 years, 20 years. Now, another parameter that we need to see is the rolling returns. That means I've done the analysis of the 5-year and the 10-year rolling returns, which means any period from 2005 to 2025, in the 20-year period, any 5-year, for example, if you'd invest in 2005 or 2006 or 2007, 2008, and just withdrawn your money in 5 years or 10 years, 10 years rolling returns, what is the impact? How are they comparable? Rolling 5 years returns from 2005 to 2025, LNMC beats 250 beats Nifty 50 in 75% of, that means 3 out of 4 it beats easily in 5 years. And the extra returns is 13%. But rolling 10-year returns, it 100% beats. That means in a 10-year period, it always beats. That means it doesn't matter. Markets go up or down. Within 5-year and 10-year period, you are bound to gain if you choose LNMC 250. That means LNMC 250 offers higher probability of superior outcomes. This is the real definition of safety for long-term investors. So 5 years, 10 years, 15 years, 20 years, hands down, LNMC 250 is a winner. So you can safely invest in this index. This is as good as Nifty in terms of the the stability of an index fund, but gives superior returns. What is the reason that you would go for a large cap index fund? Let's compare with large cap active funds. If I can get better returns in large cap active funds, right? I'll not look at LNMC 250 because I can choose a good fund manager all the time, every year, and keep chasing. Now, with this comparison, again, you'll be shocked. Here is a chart which clearly shows the position of LNMC 250. Now, here you have the top funds: Nippon India, ICICI Prudential, and here all the other funds. Here is Nifty large mid cap 250, and here is Nifty 50. And there are some bottom large cap funds like Axis, PGM, JM, LIC. That means in some parameters, 5, 10, 15, 20 years, they are below. So as an average, they are below. So if you see here, 5-year, Nippon is 20.73, ICIC is 18.55, but Nifty large mid cap is 18.93. Most of the funds are below LNMC 250. In the 10-year category, again, it is 15.59, better than Nippon, better than ICICI. Probably there is no other large cap fund which is better. It is the winner. It is number one. In 15-year category, it is 13.06. Yes, these are the two funds that are better. Probably there is one fund, Mirai, which is better in 15 years. That's it. And maybe there is one here, Baroda, BNP. These three large cap funds are better. But here is a category where you just fill it, shut it, and forget it. Don't monitor it. Good returns, good Sharpe ratio, and less volatile. And in the 20-year category, it is 13.41. There are a few funds that are better, large cap funds. It is better than most of the large cap funds. And if you take an average in the last 20 years, it ranks among the top 3. So in 5 years, it is number 3. 10 years, it is number 1. 15 years, probably it is number 5 or 6. 20 years, it could be number 3 or 4. So it's on the top. So here is a category which always gives better returns than Nifty, as volatile as Nifty, better risk return ratio than adjusted return, that is the Sharpe ratio, and it is better than most of the large cap funds. So I personally don't see any reason why I would go for a large cap active fund or Nifty 50 index fund when I have with the same stability and everything remains the same. I get something better. Plus, I pay much less fee. The fees for most of the active funds is high. But here we have a passive fund where we don't pay high fee. So I don't see any reason why I would go for a large cap fund. Instead, I would go for a LNMC 250 and just relax. Fill it, shut it, and forget it. And always get great returns. And as you have seen, the returns are quite high. Let's see the returns once again. In 5 years, 18.93. In 10 years, 15.59. In 15 years, 13.06. And 20 years, 13.41. As an average, 15% returns. And in terms of how it translates into, we've already seen. So if you had invested 10 lakh rupees in LNMC, it would be 23.7 lakhs in 5 years, 42.6 lakhs. That means 4 times in 10 years. And in 15 years, 6 times. And in 20 years, an LNMC would give you 1.24 crore. Now, this is about the lump sum. Now, let's take a quick look at and compare the SIP returns. The SIP returns are, if you'd invested 10,000 per month, Nifty would have given you 8.04 lakh in 5 years, whereas LNMC 8.83 lakh. See the difference in 5, 10, 15, 20 years. See the difference. In 20 years, you would have got 30 lakhs extra without taking any additional volatility or headache, without anything extra. this would give you returns better than any top large cap fund. So now the question comes is that how come an index fund beats beats the top large cap funds and also beats Nifty 50, which is a large cap, right? And at a very good risk adjusted returns, less volatility, almost the same volatility. But how come it beats? What is it? What is this magic about? And we'll see that this is the last section. Why is an LNMC 250 superior? Now, this is the most important part of the video because this gives you knowledge, increases your financial literacy. You will know why you can invest, not blindly invest in LNMC 250, but with full knowledge and literacy, invest in LNMC 250. Let's take a look at all of these reasons. So the number one reason, which is probably the most important reason, is the automatic rebalancing which happens without actually applying any applying the mind, doing nothing. And this is the most beautiful part. In fact, if you look at this, this will help you explain. So here is a large cap, here is large cap, here is the mid cap portfolio. This is 50-50. So here you've got all the large caps, here you've got the mid caps. So what happens is, this is what happens. Here you have a portfolio which is gone beyond 50, that is, it gone up, and here it has gone down. Now this rebalancing happens every quarter. So here, because and this is an example, because the large caps have done better than the mid caps. So because of this rebalancing, where there is a diversification happening, this is what happens. It again becomes 50 and this has become 50. So what has effectively happened is that you've sold large caps when they are rising, when they are at the high, and you have purchased small mid caps when they are not doing well. So it balances. Now this is a very important theory, probably very close to what Harry Markowitz, who got a Nobel Prize for the modern portfolio theory, where asset allocation, diversification, and rebalancing is what actually helps a portfolio to do better. And that is what the same principle here, because the mid caps and large caps always don't go, they're not always going in the same direction. So there sometimes when the large caps are doing great, mid caps may not do well. And when the market crashes, the mid caps crash a lot more. So because of this difference, this rebalancing leverages that part of rebalancing and gets better return. So if you see here, I've clearly explained, if large caps rally 55% of portfolio, it sells 5% of it, you are selling it high. Mid caps fall to 45, you buy more. So when again the market goes up, in the bull run, the mid caps will do better. And you have invested more mid caps in the probably the bear market, when the mid caps are not doing well. So effectively, because of this, the portfolio benefits. And that is the number one benefit why LNMC 250 always wins. Now let's take point number 2. Market cycle smoothing is equal to wins in every market cycle. Now here, if you see as an example, from 2010 to 2015, it was the mid cap cycle. See the returns. So the blended return is 15.5. If you only had in large cap, you would have got less. Here is the large cap cycle. Again, the blended return is, this is the blended return. If you had only in large cap, you would not have got the benefit. Now, the third is the concentration risk mitigation, which is equal to the shock absorber effect. So let's take a look. In Nifty, if you see Nifty 50, the top 10 stocks are 45% of the index and Reliance is 8%. So just imagine if Reliance crashes. So if you take this 40% into 80, that means 3.2 it is actually lost. And this is a concentration. What is a concentration? Concentration risk. That means there's a concentration in one index, a big percentage has gone to very few numbers. But if the same thing in a 250, what happens? If Reliance crashes by 40%, In LNMC, it is not, it won't crash by 3.2%. It will crash by only 1.6%. So the entire portfolio, whatever crashes, the effect of the crash is less. It is spread out because of this combination of 50-50. So that's why there's a better downside protection always. Reason number 4, the mid-cap growth premium is equal to structural advantage. I've explained it in my previous video uh, on investing a lakh and then getting 39 crores in 50 years. If you watch that video, you will know I've explained why you should focus on mid-cap funds, because when the markets are growing, mid caps grow faster than the large caps. Large caps are stable companies, big companies. The scope of growth is less, but for mid caps, they grow faster. And because of that, LNMC 250 gets the advantage. So point number 5, valuation timing is equal to auto rebalancing in better valuation. So let's take a hypothetical condition here, market condition. Okay. Um, Assume that Nifty 50 is trading at 22 times P, which is expensive. And mid caps at the same time are trading at 16 times P, cheap, right? There is a mismatch here. Now, if an investor has to buy Nifty 50, if you have invested in Nifty 50 index, you are forced to buy at a higher valuation, especially if you are doing an SIP. But in an LNMC index, you buy 50% only expensive, 50% you buy cheap. So in the future, when the mid caps go up, when the mid caps valuation adjusts, you gain, you stand to gain. So that is the advantage when you have a 50-50 index. Now reason 6, which is the last reason, is the fee advantage. If you look at the LNMC index fee is 0.25 percentage, and active flexi cap or active large caps have much higher fee, and that fee converts into lakhs of rupees over the next 5, 10, 15, 20 years. I hope you understood why LNMC 250 index is so superior. It has some inherent advantages because of this combination, and this is a very lethal combination. It's a very powerful combination, which is something so amazing. And with this analysis, with this research, personally, I am so convinced about an LNMC 250. I haven't done much research on the large and mid cap, because I believe you already have categories like large cap, flexi caps. Why have a large mid cap active fund? Again, you might wonder, instead of buying an index fund, why don't you go for a large mid cap active fund? Again, large mid cap active fund, a lot of them don't beat the benchmark. The beauty of LNMC 250 is fill it, shut it, forget it. For the next 5, 10 years, if you want to invest for any financial goal and you want to have high probability of better returns than index or the large caps, LNMC 250 is a clear winner. Whether you are conservative, moderate, or aggressive, whatever is your risk profile, you will do well. I hope this has been a bulb-on moment for you. This has opened your eyes to a great category. You can do your own research, or talk to your advisor before buying this fund. But to me, this is a winning category, a winner category, a killer category, a fantastic category that no one can miss. So if you want to have just 2 or 3 categories in your portfolio, a flexi cap and an LNMC 250 index fund are the must. Well, mid cap, small caps, and other categories, I'll continue to do research on them, and I'm going to share with you. There are so many different categories of fund. Let me know in the comment box whether you liked this video and what did you like about this video, and what are the other categories you want me to look at, while I continue to teach you on various categories of funds and various perspectives to investing. As I continue to do these videos, I hope you take advantage of this, learn it, and as a young couple in your 30s and 40s, take advantage of this. My goal is, my videos are centered around this age. If you have liked this content, you can show like, or if you didn't like, show dislike, but let me know in the comment box why. And finally, if you are convinced that this is a great channel, good channel, subscribe to this channel. Hope to see you soon with another video. Thank you. Bye for now.